Hello and welcome. If you've been learning about investing, you probably heard that the S&P 500 is a fantastic foundation. It gives you instant diversification across 500 of America's biggest companies, and that's a great place to start. But what if I told you that investing solely in the S&P 500 is like only eating from one food group? It's healthy, but to be truly resilient and strong, you need a more balanced diet. Putting all your money in the US stock market, even a diversified part of it, is still a concentrated bet. True diversification means spreading your risk across different types of investments all around the world. In this video, we're going to move to the next level. We'll explore why going beyond the S&P 500 is crucial, what the other major food groups for your portfolio are, and how you can build a simple, sophisticated, and globally diversified portfolio with just a few clicks. Let's begin. Part 1. Why stop at the S&P 500? The case for global diversification. The S&P 500 is an incredible collection of companies, but it has a specific profile. It is 100% stocks, it is 100% US companies, and it is heavily weighted toward a specific sector, technology. This means your portfolio's performance is tied to the health of the US economy and the success of its largest tech giants. But what if that's not the best performing part of the world for the next decade or two? History shows us that leadership rotates. There are periods, sometimes lasting many years, where international stock markets outperform the US market. For example, in the decade between 2000 and 2010, often called the lost decade for US stocks, the S&P 500 had a negative total return. But during that same period, many international markets, like those in emerging economies, saw significant growth. By owning only US stocks, you are missing out on all the growth and innovation happening in the other 99% of the world's economy. Think of powerhouse companies you already know: Essel in Switzerland, Toyota in Japan, Samsung in South Korea, ASML in the Netherlands. A globally diversified portfolio gives you ownership in the entire global economy, not just one country's. Furthermore, different economies don't always move in sync. When the US market is in a slump, European or Asian markets might be holding steady or even rising. This doesn't always happen, but when it does, it acts as a powerful shock absorber for your portfolio. Adding international stocks doesn't just increase your opportunity for growth, it can also help smooth out the ride. Part 2. The 3 pillars of a diversified portfolio. So, if the S&P 500 is just one piece of the puzzle, what are the other pieces? Let's break down the 3 core pillars for a well-diversified portfolio. Think of these as the protein, carbs, and healthy fats for your financial health. Pillar 1. US stocks. The S&P 500's big brother. You can actually get more diversified within the US than the S&P 500 offers. The S&P 500 is large-cap companies. But what about all the small and medium-sized companies that have huge growth potential? The next step is to consider a total US stock market ETF. A fund like VTI from Vanguard or ITOT from iShares holds not just 500 large companies, but over 3,000 companies of all sizes. It includes the S&P 500, plus thousands of small and mid-cap stocks. This is a more complete representation of the US economy. Pillar 2. International stocks. Your passport to global growth. This is your direct access to the rest of the world. An international stock ETF holds stocks from developed countries like the UK, Germany, Japan, and Canada, as well as emerging markets like China, India, and Brazil. Funds like VXUS from Vanguard or IXUS from iShares give you this entire world of investment in one ticker. This is the single most important step to take beyond the S&P 500. Pillar 3. US bonds. Your anchor of stability. As we've discussed in previous videos, bonds are the yin to stocks' yang. They provide stability and income when stock markets have a bad year. High-quality bonds often hold their value or even increase, cushioning the blow to your overall portfolio. A total US bond market ETF like BND Vanguard or AGG iShares is a simple way to add this crucial stabilizing pillar. With just these 3 pillars: US stocks, international stocks, and US bonds, you own a piece of nearly the entire global investable landscape. This is the essence of true diversification. Part 3. Building your portfolio. A simple, powerful framework. Now, how do you actually put this into practice? The beauty of modern investing is that you don't need to be a genius. You just need a simple plan and the discipline to stick with it. The most famous and effective simple strategy is the 3-fund portfolio. As the name implies, it uses just 3 ETFs to achieve maximum diversification. 1 fund for US stocks like VTI, 1 fund for international stocks like VXUS, 1 fund for US bonds like BND. Your only job is to decide the ratio between them. This is your asset allocation, and it's based on your age, risk tolerance, and time horizon. Let's look at 2 examples. The aggressive young investor age 25. A long time horizon means you can tolerate more risk for higher growth. Your portfolio could be 60% VTI US stocks, 30% VXUS international stocks, 10% BND US bonds. This gives you 90% in global stocks for growth and 10% in bonds for a slight cushion. The moderate mid-career investor age 50, getting closer to retirement, you'd want to reduce risk. Your portfolio could be 40% VT, 20% VXUS, 40% BND. This is a classic 60/40 stock A bond split, providing a balance of growth and stability. How to execute this? Open your brokerage account Fidelity, Vanguard, etc. Decide on your target percentages. When you transfer money in, simply buy the ETFs in the proportions you've chosen to rebalance your portfolio back to its target. The goal is not to pick winners, but to own everything and capture the global market's returns in the most efficient, low-cost way possible. A final word of wisdom to quickly recap. Why go beyond the S&P 500? To capture global growth and reduce your reliance on the performance of a single country's large-cap stocks. What are the key pillars? A complete portfolio includes total US stocks, international stocks, and US bonds. How do you build it? Implement a simple 3-fund portfolio using ETFs like VTI, VXUS, and BND, adjusting the ratios based on your personal risk profile. Diversification is the only true free lunch in investing. It allows you to reduce risk without necessarily sacrificing long-term returns. By building a globally diversified portfolio, you are not betting on one company, or one sector, or even one country. You are betting on the enduring ingenuity and productivity of the entire world. And that is a bet that has paid off for centuries. Thank you for listening.